Welcome to our deep dive on a controversial but practical three-step path to financial freedom, even if you're starting late. We will explore how to move from raw cash savings to true wealth through compounding. Stay with me until the end for a concise summary and next steps. Here is the roadmap for today. First, we will explain why cash alone is not enough. Next, we will cover the three core steps: building an emergency fund in a high-yield savings account, eliminating high-interest debt while maximizing employer match, and investing in broad market index funds for the long term. Then we will review compounding basics, compare certificates of deposit to index funds, walk through simple setup steps, and discuss risk management. Along the way, we will pause for quick quizzes to reinforce the concepts. This video is for educational purposes only and does not constitute investment, tax, or legal advice. Everyone's situation is different. Please do your own research and consider consulting a qualified fiduciary financial advisor before making decisions. The core message is that compounding, not idle cash, is the engine of wealth. Cash is useful as a tool, especially for emergencies, but long-term growth generally requires market exposure. The three-step system is to first secure your emergency fund in a high-yield savings account, then eliminate high-interest consumer debt, and finally automate investing in broad market index funds, ideally in tax-advantaged accounts. Begin learning compounding and risk management immediately so that your strategy works for you rather than against you. Step 1 is to protect your downside. Build a 3 to 6 month emergency fund based on essential expenses. Keep this money in a high-yield savings account for liquidity, principal protection, and a better rate than a traditional checking account. Hold it in a separate account to reduce the temptation to spend. This buffer keeps you from selling investments at a bad time during life surprises. To set up a high-yield savings account, compare reputable institutions for annual percentage yield, fees, transfer speed, and account limits. Open the account and label it clearly as your emergency fund. Automate transfers on each payday until you reach your target. If you ever need to use it, prioritize refilling it to restore your safety net. Next, eliminate high-interest consumer debt using either the avalanche method, which targets the highest rate first, or the snowball method, which starts with the smallest balance to build momentum. If your employer offers a retirement plan match, contribute enough to obtain the full match even while paying down debt, since this is essentially free money. As your debt falls, increase your contributions. Avoid parking long-term growth money in certificates of deposit, because fixed, low returns can be eroded by inflation over decades. To maximize tax-advantaged accounts, contribute to your employer plan to capture the full match as a top priority. After that, consider contributing to an IRA or Roth IRA subject to eligibility and income limits. If you are eligible for a health savings account, use it for its triple tax benefit and invest the surplus. Automate contributions and increase them each year or whenever you receive a raise. This timeline illustrates a realistic path over roughly 20 years. In the first 2 years, you prioritize building an emergency fund and paying down high-interest debt while capturing any employer match. Over years 3 to 5, you increase your savings rate and automate contributions. From years 6 to 10, you maintain discipline and rebalance periodically. During years 11 to 15, compounding begins to accelerate. During years 16 to 20, balances can snowball towards 7 figures depending on contributions and market returns. The key theme is consistency. For long-term growth, use low-cost total market or S&P 500 index funds. Automate monthly purchases so you do not rely on willpower or market timing. Maintain a time horizon of 15 to 20 years or more. Rebalance annually to your target allocation and avoid attempting to time the market. Comparing certificates of deposit to broad index funds clarifies why CDs are risky for long-term growth. CDs offer fixed, low returns and principal stability, but face inflation risk that erodes purchasing power over decades. Broad index funds expose you to market volatility in the short term, but historically have delivered higher long-run growth potential. Reinvested dividends and compounding work over time. For money you do not need for decades, broad market exposure is generally more appropriate than long-term CDs. This table presents rough projections for investing at a 7% average annual return compounded monthly over 20 years. $1,000 per month may grow to approximately $520,000. $1,500 per month may grow to roughly $781,000. $2,000 per month may approach about $1,042,000. These are estimates, not guarantees. Actual results will vary with markets, fees, and behavior. Effective risk management includes diversifying across stocks and bonds in line with your risk tolerance and rebalancing annually to maintain that allocation. Maintain your emergency fund of 3 to 6 months of expenses in a high-yield savings account, extending toward 12 months if your income is unstable. Improve your margin of safety by increasing your savings rate through income enhancements such as side work, skill development, and salary negotiation. Quiz time. Where should your 3 to 6 month emergency fund live? Option A, a high-yield savings account. Option B, a 5-year certificate of deposit locked in. Option C, a total market index fund. Option D, a cryptocurrency wallet. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A, a high-yield savings account. Emergency money must be safe, liquid, and accessible without volatility or penalties. A high-yield savings account fits this purpose best. Second quiz. After paying off high-interest debt, which action has top priority if your employer offers a match? Option A, buy long-term certificates of deposit. Option B, contribute to get the full employer match. Option C, keep everything in cash. Option D, day trade alternative cryptocurrencies. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, contribute to get the full employer match. An employer match is effectively free money and provides an immediate, low-risk return that should not be left on the table. Here is a minimalist playbook to keep and reference. First, build 3 to 6 months of expenses in a high-yield savings account. Second, pay off high-interest debt while capturing any employer match. Third, automate monthly investing into low-cost index funds. Fourth, rebalance annually and increase your savings rate with each raise. Fifth, ignore market noise because time in the market beats timing the market. Sixth, revisit your allocation yearly as your goals evolve. This flowchart maps your monthly cash flow. Income first covers essential bills. Simultaneously, automatic transfers fund the high-yield savings account until the emergency fund target is reached. Income also flows to retirement contributions up to the employer match. Any surplus then goes to IRA or HSA contributions and is invested in broad index funds. After the emergency fund is complete and high-interest debt is eliminated, auto-investing is increased. There is also a feedback loop for annual rebalancing and escalating contributions. These are the key takeaways. Cash protects while markets grow, so use both appropriately. Keep emergency funds in a high-yield savings account and avoid relying on it for long-term growth. Eliminate high-interest debt and never skip the employer match. Automate low-cost index investing and allow compounding to work over time. Diversify, rebalance, and increase your savings rate as your income grows. To wrap up, open a high-yield savings account and automate transfers until you have 3 to 6 months of expenses saved. Contribute enough to your employer plan to capture the full match while paying down high-interest debt. Then set up automatic monthly investments into broad index funds and stay the course. These actions create a durable system that compounds over time. Thank you for watching. If this guide was helpful, please like the video, share it with someone who is starting late, and subscribe for more practical money strategies. Share your questions and your personal plan in the comments. I read them and respond to help you move forward.